There's a lot of doom and gloom in the economic news lately, and for good reason. There's a lot to consider. We are days away from the next Fed meeting and another expected rate hike. We also have the highest inflation in 4 decades, recession fears, COVID, and the impact of the Russia-Ukraine war. That's quite a bit for investors to worry about, but it doesn't imply that disaster is lurking around the corner. I'm Chris Sabul, and I'm here with Mark Armbruster to discuss the dark cloud over the stock markets and the silver lining that could lead us back to a bull market.
While we'll lay out an optimistic case in this vidcast, we're just not that optimistic about the economy generally. Watch our companion piece called The Bear Market Case for a more balanced perspective on today's investment environment. We've included a link to the video in the description below.
Right now, stock market sentiment is about as bad as it gets. This chart illustrates individual and institutional investors' lack of confidence in the stock market. Confidence levels are almost at the same lows as during the painful global financial crisis in 2008.
That's not surprising given how stocks and bonds have performed this year, but sentiment tends to be a contrary indicator. Usually when investor sentiment is at its worst, the market is making a bottom and it's just about to rebound. The low point for sentiment in 2008 shows that it bottomed just about the time that the stock market was also making a bottom. So with everyone sure that the market will get worse, it could be time to start thinking about a rebound.
There are other reasons to be optimistic, including stock market valuations. The cyclically adjusted price-to-earnings ratio, or CAPE ratio, is a metric used to evaluate whether the market is undervalued or overvalued relative to long-term earnings. The CAPE ratio currently stands at 28 for the overall U.S. market. It's still well ahead of the longer-term average of 17, but down considerably from its high of 38 late last year.
And there are segments of the stock market, including value stocks, international stocks, and small cap stocks, that are far cheaper than the overall market. It's certainly possible that investors will start to take advantage of these lower valuations, driving stocks higher from here.
There is also potential for a short squeeze that could move stocks higher in the near term. When sentiment is as dismal as it is today, some investors, particularly hedge funds, may take short positions in the stock market, hoping to profit from further price declines. Then, if prices move higher, those funds often act to stop their losses by repurchasing the stocks they sold short. That additional buying pressure could result in a quick rebound to higher stock prices.
It could also be that stocks move higher from here because there aren't really any great alternatives for investors to park their money. The bond market has not been the safe haven it has historically been during times of stock market duress, and investors are giving up on bonds with the prospect of further Fed interest rate hikes, which drive bond prices down.
You could look to the safety of U.S. Treasuries. They are currently yielding their highest payout in years, around 4% at some points on the yield curve. However, even though Treasuries are far more compelling than they have been in the past few years, they still aren't keeping up with inflation.
Right, so a long-term allocation to stocks continues to make sense, given the lack of upside potential in other asset classes, which could put a floor under further stock market declines.
The most significant catalyst for stocks could be a Fed pivot. The Fed has been raising short-term interest rates to battle inflation. These rising rates drain liquidity from the economy and hurt the valuations of both stocks and bonds. However, a growing chorus of economists are saying the Fed has gone too far, too fast, and will have to reverse course or pivot as it tips the economy into recession or causes a financial crisis.
We've yet to see any rate cut indications from the Fed, but history shows the Fed does drop rates when economic pain sets in, such as around the uncertainty of Y2K, again during the global financial crisis of 2008, and more recently during the COVID shutdown.
Any cut in interest rates or softening of the Fed's hawkish stance would likely move stocks considerably higher in short order.
Again, this is not to say that we're feeling terribly optimistic these days, but there is a case to be made that most of the damage in the stock market is past, and there are some catalysts for a rebound from here.
Right, that is not our base case assumption, but this is the first time in a few months that we've been able to make even a modestly bullish case, and that could mean we're getting closer to the bottom. Thank you for joining us today, and drop a comment if there are other topics you'd like us to cover.